All right, guys, we're ready to go on another episode of Off the Sidelines Property Podcast. It's Dan Peachy here and my co-host, Onus Asari.
Hey guys, thanks for joining us again. And we have Terry Wong with us from Fundex Capitals today. And he's just going to share his story and how he got into the mortgage lending space and how he's helped his clients succeed with getting a mortgage and buying their first homes and next homes and investment properties. So Terry, I'll get you to introduce yourself a bit and we can take it from there.
Sounds good. Well, first of all, thanks for having me, guys. And as you've introduced, I'm Terry from Fundex Capital. And yeah, so you want some success stories, do you?
Yeah, well, I guess, look, why did you start Fundex Capital? What's your
driven me? Yeah.
philosophy and what made you, leave your, I guess, your corporate job, is assuming that, you've been working in corporate and starting out on your own?
Yep. So prior to starting Fundex Capital, I was working in one of the major banks for 11 years. So during that time, I had exposure and experience across home lending and business loans. But,
Yep.
So the main thing that really drove me was when I was working for one bank, we had that one set policy guideline. There were so many times when customers would come to me saying, I need finance for this, I need finance for that, but they just did not fit the policy and I had to turn them down, and it just got me thinking, like, if I become a broker, I've got the skill sets, I've got the knowledge, and there are so many other lenders out there that I could refer them onto, or not refer them onto, but actually do the deal for them through to actually help them get that finance.
Because it meets their criteria, yeah, so you
Exactly
can help them
right.
out. Absolutely.
So it's more broad, there's a lot of lenders out there that would accept client situations with less documentation and, look at the more holistic picture rather than looking at the black and white as to what's on the paper, right, in terms of income and expenses. So that's, I guess, the main driver for me to drive an inspiration to start my own business as a finance broker. So helping home loans and business loans, asset finances, anything finance related, really. Yeah.
Yeah, awesome. And have you got any examples of any people that you've recently helped out that traditionally a bank probably they wouldn't meet their criteria or anything like that recently?
Sure. So there's one that really stands out to me. So there was a client of mine that was going through some financial hardship. Mm-hmm. Obviously, I had to deep dive. Why are you in the financial hardship? Like, if you've got a gambling problem, that's not a good thing. Like, I can't help you there.
Yeah.
No banks are going to help you out either. But turns out they told me the whole life story. So it's a couple, male, female applicant with two children. Mm-hmm. So the father, unfortunately, was diagnosed with cancer. So they used all their savings, maxed out all their cards, everything.
Wow.
For treatment. Mm-hmm. And they were just living paycheck to paycheck. The home loans were in arrears. They were on payment plans and all sorts of stuff, right? And they're just like, we are struggling, but we have equity in our property. I need to do something about this. Mm-hmm. And, the major banks would be like, no, hard no. You're in arrears, your credit cards are maxed, your late payments left, right and centre. Mm. But again, that's the benefit of engaging with a broker, right? We've got a whole panel of lenders and some lenders would actually take on these clients. So their credit score, again, was impacted as well. But there are lenders out there that don't even look at your credit score. Mm. They want to understand the situation. They listen to the story and based on that, they'll give them merits and they lend the money.
So instead of a system says no approach, they look at the story and the situation and
Correct.
Can help accordingly.
Yeah, so we've managed to refinance them, debt consolidate as well, pull out the equity, pay off all their credit cards. Credit card rates are what? 20% now, right? Mm. So they're just struggling, meeting those minimum credit card repayments. They've got car loans on the side as well, paying ridiculous amounts of money every month. So what we managed to do was refinance their property, release equity, pay off all those debts that they had. So they only had to worry about doing one repayment a month, the home loan repayment. To top it all off, we managed to even refinance that property under interest only.
Nice.
Meaning it's giving them more, it's saved them repayments every month, giving them, a bit of relief in terms of cash flow, and just help them get them back on their feet. And yeah, that's probably, it really hit me because I really wanted to help them when I heard their story, and I was like, okay, I'm a broker now, I can do this. And
nice.
it took a while, but we got it over the line.
Yeah, that's awesome. And you're definitely a superhero in their eyes. So, in terms of your panel, what would you say, what's the percentage of lenders that are black and white, and what's the other percentage of lenders that would give, points on stories and that kind of stuff and personal background?
So again, it comes down case by case and how as a broker we present the story nicely to the bank, right? I wouldn't say so. The majority of them would be a hard no, because if you're on a hardship arrangement, no, they don't like it. They want you to have at least 6 months of clean repayment records before they'll even consider looking at the deal. There aren't many that would actually lend to those customers in those situations. However, there's honestly not many, probably a couple that I know of at least that I've succeeded with. Yeah.
Okay, awesome. And Terry, just in terms of the clients you service, I know that there's a thing called LMI and no LMI, and it just becomes a bit complicated. So is there like a favorable situation where a client's looking to buy a home and they're trying to purchase and they can, get away with not paying lender's mortgage insurance, LMI? What does that look like to you in your space?
Yeah, sure. So LMI is an option that people can take. So again, LMI is a lender's mortgage insurance.
Yeah.
It's an insurance premium the bank charges the client because they're lending a higher percentage against the property value. So that it's like a risk fee, so to speak, right?
Yeah.
But it's ensuring the bank that if anything goes wrong, that they'll be able to recoup their money. So some lenders, yes, have policies in place where LMI can be waived. Depends on profession. So medical professionals, solicitors and accountants, people like that are able to get LMI waived. But there are, again, certain criteria, and the criteria differs from bank to bank also. So some might have a minimum income threshold. So if you're an accountant, yeah, sure, but are you earning more than 150K? If you're not, they go, sorry, you're not eligible. So again, we've got a big panel of lenders. Everyone's got a different appetite and different niches. So as a broker, it's our job to find that fit for the client.
Yeah, nice. And in terms of the way the interest rates are going, do you still think there's still some competitive deals out there at the moment, or everywhere is similar, they're just sort of increasing at the moment, or there is still some good deals to get out there at the moment?
Oh, there's definitely good deals out there.
Nice.
That's a no-brainer. So yeah, the rates go up. Every bank passes it on in full, right? Like, who's going to not do that? So yes, I mean, the rate differences are actually very big because smaller lenders can afford to actually, charge a lower rate compared to some of the bigger ones.
Yeah.
On top of that, if we're talking about refinances, people are eligible to get refinance cashbacks also as like a thank you for moving it over to our bank.
Yeah.
And again, talking about policies and niches, like there are lenders out there that would maybe even waive LMI up to 85% for owner-occupied and things like that.
Cool. For sure. And another question that I've been getting personally is just tips and tricks to pay off home loans or mortgages faster. Do you share any kind of tips and tricks with your clients, or what's your thoughts on that?
Tips and tricks. I mean, we've got, when it comes to mortgages, essentially two types, if you want to call it, if you want to make it very broad, right? We've got the offset accounts and we've got the redraw home loans.
Yeah.
So again, offset accounts, the more money you have in your offset account, which is like your daily transactional account, where the repayments will be drawn out from, the more money you have in there, the less interest you'll be paying on your loan. So for example, if your loan is $500,000 and you've got $100,000 in cash sitting in your offset account, the bank's only going to charge you interest on that $400,000. Other things that I tell my clients who are new purchasers and have no idea about the property game and might have got a windfall inheritance. Yeah, sure, I'm doing a pre-approval for them. They're going to look for a house, but they're not going to find a property tomorrow, right? It'll take them a few months. So these guys, coming from a banking experience myself, I tell them, do you know about savings accounts? Why don't you park your money in that savings account? So even while we're looking for the property, you'll be earning interest in those savings accounts. So, it's all about the care factor. So I'm not just there to do that mortgage for them. I'm there to, just help them financially grow themselves and just become more savvy investors.
Yeah, awesome. I like that response.
And do you deal much with the first homeowner grants and things like that at the moment?
First homeowners grants, not really, so to speak. Reason being is there's certain thresholds, that to be eligible for the first homeowners grant, right?
Yep.
And people are just quite uncertain in this current market to be putting down deposits for, say, off the plans and things like that, because they're just worried, what if the market continues to go on a decline? Then we might have undervaluation when it comes to settlement, and yeah.
And in relation to like the 2 or the 5% grants from the government, do you do any of them as well?
I've had a few inquiries around those, but again, those are long game sort of clients.
Yep.
I do them, yes. However, again, not all lenders are open to doing that.
Yeah.
Only some lenders sort of accept, the first home loan deposit scheme, and there's only certain spots available for them. So, but I think most of the spots have filled up for this year at least, yeah.
And is your typical client your owner occupied or your investor client, or you have a bit of a mix?
We've got a bit of a mix. Majority, to be honest, would be investors.
Nice.
Yeah. But owner occupieds, yeah, they're definitely quite. It's definitely a mix that I've got. Yeah, owner occs and investors. Investors are probably easier clients, so to speak, because they've already had funding from a bank, so that their income is going to be enough to service the loan, and there's lots of opportunities in the refinancing space for them.
Yeah.
For
new purchase clients, again, it comes down to finding the right bank for them to fit their specific situation.
Yeah, nice. Yeah. And when it comes to refinancing, how does that typically work for a client? Are they typically starting on a new loan term for another 30 odd years with a different bank, or what does that typically look like? Are they starting from, the same kind of amount that they've got left with their previous bank?
Yeah. So again, this is a case by case, depends on the client and what their financial goals are. So some people want to refinance and stretch the loan back out to 30 years. Now, the obvious benefit of that is your repayment amount is going to be reduced, and it's also going to increase your borrowing power. When people refinance, we also can look into exploring whether there's enough equity in that property. So we can release the equity, because if they're investors, they want to pull that cash out and purchase the next property.
Yep.
Yeah.
Yeah. And do you find that the people that are doing equity releases, that a portion of that can go towards personal use, holidays, buying a car, just to splurge a bit on their own personal kind of taste and experiences?
Yeah, you definitely can, but obviously it needs to be not overly excessive, otherwise the banks go, is this really responsible lending here? Yeah,
okay. Because then that just makes it a bit creative, because let's say you're a smart investor and you've got a couple investment properties that have appreciated in value. You can refinance that, and then if you want to go on a holiday, or you just want to take a bit of time off work, you can potentially do that by building up your asset base.
Correct. Yeah, definitely.
Yeah. Fantastic.
And in terms of the lenders at the moment, opposed to 12 months ago, do you think they traditionally still have the same appetite to lend with similar criteria, or are they pulling back on a lot of things and asking for more documents now, do you think?
In terms of documentation and drilling down into living expenses, I think post Royal Commission, that's when things really started tightening up.
Yep.
Lenders realize, okay, we've been giving out money left, right, and center a little bit too freely. Well, before Royal Commission, what customer goes, oh, I spend $500 a month. Tick. Okay, next.
Yeah.
But now it's like they use a different measure called the HEM, the Household Expenditure Measure. So they actually tier your living expenses based on your income as well.
And all lenders have
All
this
lenders do that.
metric?
That's right, yeah. So, yeah, the HEM is a big thing, but again, depends on other ratios that come into play. So DTI, which is the debt to income ratio. So if that goes above a certain threshold for that bank's appetite, that's when they might even ask, okay, well, I need to see 3 months of your daily transactional statements just to verify that what you've told me is your living expenses are accurate. But some lenders might not even ask for that.
Yeah, awesome. And let's say I'm a young investor, right? I don't earn a lot. Let's say my salary is $50,000 per year. What's the ratio that banks kind of use to calculate on how much they'd borrow? Because would the property rental income be a massive factor in that calculation? And if you know, if you can share a bit about that and your experience with that.
Yeah, definitely. So when you're purchasing a property as an investment property, we can take your salary.
Yep.
And we can also use the rental income that property will bring in to factor in, and the banks would lend you more money because you have more income, or you've got the current income plus the future rental income. So they take the combination of both of that to assess how much they'll lend you. But we also need to consider other factors as well. Like, does the applicant have credit cards, for example? If they have credit cards, personal loans, car loans, buy now, pay later facilities, all of those actually are very detrimental to the servicing.
Yeah.
So what we also advise clients is, look, if you've got a credit card, you're not even using it, just cancel that, then we can lend you more money.
Yeah. And then potentially just get one after.
That's up to them.
Yeah. Nice. I like that.
And if you're getting cash flow positive properties, it's going to give you more income to then buy your next investment property.
Definitely,
well.
yeah.
Yeah, absolutely.
So what's your opinion on negative geared versus positive geared properties?
So honestly, negative gearing, yes, could be good, but it would only be good in the situation where you're negative gearing due to tax depreciation. You know, like especially in the current market where interest rates are rising.
Yeah.
And if you're negatively geared, so to speak, and you know your repayments is a lot larger your repayments are larger than the rental income, and the rates keep going up, you're just going to keep struggling.
Yeah.
And is that trade-off really worth it? You know, you're trading off your quality of life in return to, you know, see a bit of a tax benefit there. And again, it's the income tax thresholds, right? Is it really going to be worthwhile for you to be chasing negative gearing?
Yeah.
Unless you're hoping for huge growth and sitting quiet and hoping, then you're just really just waiting for the market to do its thing. And if it doesn't, then you're out of pocket and you've got to
That's right.
foot the difference, right?
That's it.
Yeah, absolutely.
Awesome. Do we have anything else for Terry? Or
I think a question that's coming up on our end a lot is about valuations. So, example, some areas there's been a big drop in essentially the Sydney and New Melbourne markets and things as well. Rural and other states haven't had too much of an impact from a valuation perspective, but are you finding that a valuation that was done, say, 6 months ago and then has to be redone now is actually less in some areas? And what are you doing around that to try and facilitate that?
Yeah, so valuations are definitely coming back lower. I mean, I've even had cases where customers bought a property 3 months ago. It's come back shorter now already.
Wow.
So in terms of valuations, there are quite a few. There's about 3 different types of valuations that the banks use. So one's the full valuation, where they send someone out, inspect the property, and scope everything out and walk through the property, right? Second one's the desktop valuations, like the automated automated ones for the computers.
yeah.
So that just pulls the data and comparable sales and all that, and it'll just spit out a figure and just give it to you. The third one's a bit of a hybrid between the two. It's called a curbside. So what happens there is someone goes to the property but doesn't go in, sort of just looks around from the outside. Yeah,
Has a
okay.
stalk, yeah.
Yeah, pretty
Nice.
much. Just has a stalk and
Sounds
goes,
a bit
yeah,
creepy, but yeah.
looks all right, and then looks at a few datas in the area and goes, yeah, this is what I think the value is. So the benefit of these different types of valuations, it's again case by case, but every bank would value, well, every valuation company would value the property differently.
Yeah.
So there's a whole panel of valuers out there as well. So let's say my client wants to refinance their home loan to bank A, and we want to pull out equity up to 80%. And the bank, say, gives you a figure, okay, your value is 500,000. And then customer goes, okay. But then we go to bank B. We ask them, let's do a valuation through bank B. Bank B might go, oh, your property's worth 600,000. Where are we going to go? We're going to go to bank B, 600,000, because that's going to give us more room to release more equity.
Absolutely.
For sure.
Yeah.
Nice. That's great. So, sorry, mate.
Yeah, no, that's a really good point in terms of the valuations. Like, I feel like a lot of the lenders try and do the AVMs just to speed it up a little bit, or the desktops just to speed it up a little bit. But if it's just going, and especially in areas that don't have a lot of data, that's really hard too, because it's like, well, they may have done 50 grand in renos, but we're not even going to look at that. We're just going to run an AVM or a desktop and says the value is 500. But to your point, it could actually be 600, and then they could be getting an extra 100K out or 80% of that value on their next purchase. So it's really important to be going to the right providers and getting the right vals done as well.
That's right. So, as brokers, we always have options to speak with a bank. If we feel the value they've given is under, we just have to provide them with evidence and mitigations as to why we think the value is more. And then we can ask them, please do a full valuation, send someone out. Customers redone their home. It's definitely worth more now.
Yeah.
Then they'll do that.
100%.
Yeah, for sure. For sure. Yeah, so I guess my question was, even with us recently, we've done renovations for a client, and the renovations costed around $40,000. Our client would have purchased their property for around $650, but just based on comparable sales, the property would be worth around $800, right? But then what the bank have done is they've just added the cost of the renos on top of the purchase price. And then we're like, okay, look, we've done these renovations. We feel like the renovations would have at least, given that property some kind of manufactured equity. But the valuer has just said, oh, all right, look, you bought it at 610, for example, and, you paid 40 grand in renos, 610 plus 40, 650, and then it's that's
it is what it is.
Yeah. So and when you're trying to manufacture growth and build equity, it doesn't necessarily work like that, because all right, you might have spent 40 grand, but then the value of that, what the market will pay for that 40 grand of expenditure done right, you should at least realize some kind of return on that. So how would you kind of fight that or claim that kind of increase in price?
Yeah, so that would also come down to how soon after, say, the purchase of the renos have been done that you're requesting a valuation. I'd say maybe every 6 months or so. Why not? Just speak to your broker, let them contact the banks and request a valuation every time, because if you're requesting a valuation every month, the system's going to know. Owners did a valuation last month, we're just going to give them the same figure.
Yeah.
But if you put a bit of gap in between the time, gap in between the valuations, there's more likelihood that, they're going to go, okay, maybe it has gone up, and they're going to check the market conditions around that suburb and all that stuff as well.
Yeah, for sure. Yeah.
Well, I think that's it. We'll give that a wrap. Thanks, Terry, from Fundex Capital. He puts the fun in Fundex and the fun in Fundex Finance. So he's the man, and thank you for your time today. Got a really good insight about you and what you know about the market and your journey. So thank you for that.
Thanks for having us.
Thanks, Terry.
Cheers.
Appreciate it, mate. Awesome.